Hey everyone, happy Turnaround Tuesday, or I guess probably more appropriate, Choppy Sloppy Tuesday. Welcome to Chart This with Dave Keller. I'm your host, Dave Keller, coming to you from a actually beautifully sunny but quite cool Redmond, Washington. Thanks for joining me every weekday after the close as we break down the market action using the best practices of technical analysis, a toolkit that is optimized to really help you understand the markets using price action as your primary input. Price is king. Price is fact. Those are things that my mentors taught me early in my career, and I still believe that here in 2024 because humans are still making very human decisions, and that came out of a lot of conversations I had at the Money Show in Orlando. And again, great to see a number of you live in person, which was a lot of fun. But a lot of the conversations I have really came down to the fact that human nature is still super relevant, and the market moves irrationally because of the irrational actions and mindsets of all of the millions of individual investors and that interplay of fear and greed, of buying pressure and selling pressure, and how they all relate. We do our best on this show to try to break down the message the markets are providing back to us. Appreciate all of you streaming wherever you're at, on Facebook, on LinkedIn, on YouTube, on X. I appreciate it so much. I can see comments that you're making on whatever platform you're on. I'll do my best at the end of the episode to bring on a question or two and answer them live on the show. Any questions we don't get to, we'll go into our mailbag. We are planning a mailbag episode on Friday of this week. Also, I just got the raw footage from some of the conversations I had last week at the Money Show, interviews with Peter Schiff, Mark Skousen, Adrian Day, Mike Turner. I'm editing those and we'll hope to release them as soon as I can. Some really thoughtful conversations about the election season, about non-U.S. markets versus U.S. markets, about gold and precious metals, about the AI trade, about long-term versus short-term. A lot of really cool conversations. And please check that out on my YouTube channel. Subscribe there if you haven't done so already, and you won't miss when the episodes are released. All right, let's get to our market recap and see how things played out today. I called it kind of choppy, sloppy Tuesday. I think that's about as good of an adjective set as I can come up with today. The S&P actually finished not far from where we finished the session yesterday. If you remember yesterday, right, that big sell-off from around 10:15 to 11:30 a.m. Eastern time. We did sort of rally a bit into the close yesterday. Today we gapped lower at the open, but sort of progressed higher through the course of the day. But look at the last couple hours. We kind of just got to yesterday's close and then just sort of treaded water right around that period, right? So the market kind of telling you we're right about at the right place, given all the competing narratives and competing influences on the market. The S&P closed just slightly above 58.51, and that's, again, just a couple points away from where we were on yesterday's close. So I'll call that generally unchanged. NASDAQ Composite was up slightly 0.2%. This is kind of an unch day for the major averages. Mid caps and small caps were down a bit. So that's kind of been a theme to watch here recently. I'm seeing that pattern where large cap, mega cap names are holding up. So Microsoft, for example, today up over 2%. We'll see how it closed, but that was what it was looking like as I was prepping for the show. But small caps are down 0.6%. We saw that yesterday as well. So, you're certainly seeing continued rotation out of some of the more speculative smaller cap names. Breadth conditions not looking particularly strong today, even though the benchmarks were flat. Breadth was more negative than positive, right? More decliners than advancers. And that tells you, I think, a lot about the real story underneath the hood of the major averages being flat for the day. The VIX, again, not much of a change, down slightly, still just above 18, but well below 20. And 20 is that back of the envelope level that I like to watch, the threshold between low volatility and high volatility. Low volatility is still the story until we get back above 20. So for now, it's telling you things are not too bad. Rates continue to push higher. I've got a couple charts to share with you to try to make sense about interest rates. I've gotten a number of questions about the interest rate environment, why yields are going up after why they went down. I can't give you a full masterclass on the interest rate environment, but I will give you a couple charts that hopefully help you make sense of what's happening here. I would argue it's about changing expectations. And I think the sort of narrative we were all kind of understanding, which was aggressive rate cuts through the end of this year into next year, market's not really pricing that in anymore. I would say I think they're pricing in a much slower pace of rate cuts. And so I'll show you some charts that, hopefully tell that story a little bit. Dollar up a little bit, not a huge change from yesterday, but the UUP was up slightly from yesterday's close. Continued upside follow through in the commodity space. Gold and silver both having decent up days. And again, when you think about the benchmarks being flat in the equity side, a lot of stocks like the eco-weighted S&P probably down a little bit today, and gold and silver up. That tells you, I think, a little bit about where investors are rotating some of their capital. So silver up almost 3% today. Crude oil prices up, with the USO, which is a crude oil ETF, up about 2.4%. All of these top commodities were in the green here. Cryptocurrencies kind of choppy today, and no real change from where we were yesterday. Bitcoin is currently sitting just above 67,500. Ether prices just below 2620, and kind of mixed, I guess, for the rest of the top 10 coins tracked here on the stock charts platform. Looking at the 11 S&P sectors, you can see 4 up, 7 down today. Your 4 sectors that finished in the green. Consumer staples, number 1. Some areas of consumer staples, and again, we're kind of in the meat of earnings season. When I do my show, when I've done a show in the middle of earnings season, I can get just to a small handful of stocks, even though so many have reported earnings. So if I don't get to some of the names that you're following or that impacted your portfolio, I apologize, just because there's limited time and I can't get to everything. But tobacco stocks up big. Philip Morris was up double digits today when I checked earlier. So the XLP is your leader, up 0.6%. I've not been able to say that very often in 2024. Energy, number 2, up about 0.25%. REITs and communication services both up about 0.1%, so just above flat. On the downside, you have industrials. You'll see like Lockheed Martin, Raytheon, some of the defense stocks actually took it on the chin pretty good today after earnings. These are stocks that have been in primary uptrends and aggressive uptrends in a lot of ways, I would say, through much of 2024, given geopolitical risk, given the situation in the Middle East, given the prospects, I think, of a Trump presidency. I think that's pricing in a lot of upside for those defense stocks, maybe getting a little too overpriced at this point, given expectations. With the XLI down about 1.2%, materials down just under 1%, consumer discretionary third from the bottom. Looking at the Magnificent Seven and Friends, and I did get some great recommendations yesterday to add to this list. I probably will at some point. I don't like to tweak a list like this too often, but I think you could make the argument of like a Broadcom or a Taiwan Semi. I get it. I get the argument. I just don't want to make it too much of a semiconductor thing. I think we already have NVIDIA in there that's kind of covering that space, I guess, a little bit, but something to think about. Microsoft, for the record, up over 2% today. One of the stronger names, obviously in this group, the strongest. Meta also up 1.2%. These are 2 of the mega cap names, certainly to watch. Microsoft in particular, because, I would say still something to prove. Meta is sort of, making new highs, but others like Microsoft and Alphabet are actually still well below their previous, their all-time highs. On the downside, Netflix down about 1%. Netflix, obviously, earnings here recently. That was last week, where great quarter actually, and the market rewarded Netflix for sure. And they announced that they won't be reporting subscriber numbers going forward. That arguably is the sign of a maturing growth company, right? We're going from we're not making enough in revenues because it's all about subscribers, it's all about eyeballs, and you actually want to focus more on the revenue growth. That's actually the sign of a maturing growth companies. Arguably, that's a good thing, and that's what I think the market was saying. Tesla down 0.4%. They report earnings tomorrow. All right, let's continue on and go through some of the charts here. Before we do that, I do want to get to the market recap in the form of the market carpet. I actually did a video yesterday on Monday on Stock Charts TV, the Stock Charts YouTube channel, on this visualization, the market carpet. Talk about some different ways to use it. So make sure you check that out. A lot of great content still there, focused on the Stock Charts platform and different tools and techniques to use. I'm super happy to be contributing content to the good people of Stock Charts. But in reflecting on this visualization today, kind of a mixed bag, right? And again, the way we're going to use this, number one, what's your overall, sense of the market today? I would say not a lot of bright green, and certainly the things that are bright green are not the big names. We'll get to that in a minute, but I would say kind of flat to slightly down. And I'm particularly noticing clusters of more bearish kind of coloration here in the industrial sector, in consumer discretionary, maybe in materials and maybe some healthcare. That's where we're seeing sort of a concentration of a negative move, but this definitely feels like a flat to slightly down kind of day for stocks. Second thing, look at the big dogs, look at the big names. Microsoft obviously stands out in the upper left corner, up over 2% today. Note that some of these mega cap names not finishing in the green, particularly NVIDIA, which has been, it actually didn't make a new closing high today, so it can happen. Alphabet up, you can see some other ones as well. But I'm also noticing Walmart up 1.5%. On a day like this, where sort of feels like flat to down is the story, looking for things that are up, and that gets us to the third point. Look for outliers. Look for things that are interesting and maybe surprising a little bit. I'm noticing in the consumer staples sector, which was the top performer today, besides Walmart, you had Philip Morris, as I mentioned, reporting earnings. Altria up as well, but Philip Morris was up over 10% today. So that's pretty interesting. Also notice some of the red that you're seeing in industrials. GE down 9%. We're going to show that chart in a little bit. What concerns me about GE going down 9% is they had a pretty good quarter. They actually had a pretty good report. The report was great. The outlook was good. And the stock's getting dinged. And so arguably this is sort of a taking profits. When the market's selling off on good news, that doesn't make me feel particularly well, because that tells me that investors are thinking that all that optimism might kind of be priced in here. And the stock is dropping, even though the earnings were fairly robust. And obviously, the clusters of red that you see here in consumer discretionary, home builders in particular jump out. You see D.R. Horton here down 3%, Pulte Homes down over 7%, Lennar down about 4%. I think we showed Lennar yesterday, I believe. But these are plays that have done quite well as rates were coming down. That's when homes become more affordable. All of a sudden, the 10-year yield is kind of pushing back above 4%. All of a sudden, getting toward 4.25. All of a sudden, getting 5% doesn't seem that far away anymore as we're trending back to the upside. So home builders are a bet on lower rates, right? The lower that rates are, the better that is for home builders when there's more people feeling that they can buy homes, more home improvement retailer spend and all of that. So certainly taking some negative, and some others, things like Etsy, which have been in primary downtrends for the entirety of 2024, not getting a bid just yet, continuing to go down through the course of this year. All right, we continue on looking at the market misbehavior live chart list. As a reminder, you can get to this chart list on the Stock Charts platform. I'll show you really quickly how to do that, by the way. If you go to stockcharts.com, there's this button that says articles in the top left. You go to my blog called The Mindful Investor, and you will see this little gray button that says live chart list. If you click on that, save that, bookmark that link. This is a live list of charts. I'm picking some of the charts from that list along with others here, but this is a list of mostly macro charts, some breadth, some sentiment, a lot of price action that I actually keep updated on the Stock Charts platform. So if you want to follow some of the charts that we're looking at on the show, that's a great way to do it. Whether or not you're a Stock Charts user, you can access those charts. All right, here's the S&P 500, and if you look, over the last, 48 hours here, market-wise, we've now broken below at least that initial trend line. Yesterday, we traded below that purple trend line, and that's sort of a shorter-term trend line, what we call an accelerated trend line, because the price was getting further and further away from this sort of basic trend line we'd drawn from the August and September lows. So I drew a line with an accelerator, an increased slope to sort of match the new pace of the uptrend. And over the last couple of days now, we've started to trade below it. We're not really breaking down aggressively, but we're certainly not above that trend line anymore. And so we sort of made that initial breakdown. Again, for me, I think with the timeframes, I think about sort of that 5,650 to 5,700 range. That's still the level that I'm watching. And as long as we hold that, I would consider for now any sort of pullback to be just a pullback within a primary uptrend. We start breaking that level, I would have to reassess that condition. Also note that the momentum is still quite strong, right? The RSI is kind of run in the mid 60s. That's kind of a standard, nice, slow and steady bullish kind of range. The RSI breaking down below 50 and even worse below 40 would tell you to watch out, look out below, that there's a much further downdraft. So what happens after you make a new all-time high and you have that sort of first pullback, which it feels like we might be doing here, it's all about where that ends, right? It's where do we find support? Do additional buyers come in, buying on the dips, riding the price to yet another high, and we have just yet another brief drawdown during a very bullish 2024? or something's different, right? We start making lower lows. We start undercutting increasing slope moving averages. We break below trend line support. That would be a sort of a bearish outcome to any sort of pullback. So for now, I would argue still kind of noisy, but above those main sort of trend measures. The McClellan oscillator, as of yesterday's close, as of Monday's close, did go back below the zero line. We talked last week from Orlando how the McClellan oscillator had gone back above zero after spending a couple weeks below the zero line. As of yesterday, it's gone back below. We don't have this updated for today's close just yet, but based on the advanced decline data, I would say highly unlikely it went back above zero today. So I would say as of tomorrow, I'll probably color code this back to bearish red. It's been noisy for the McClellan oscillator, and this is a short-term breadth measure. It's a good indication of short-term swings in breadth conditions, and then the longer-term swings tend to be reflected on some of the other charts that we would talk about, like stocks above moving averages, like the actual cumulative advanced decline lines. If they start to rotate lower, that would tell you it's more of a sea change, more of a broader change. For now, though, again, I don't feel as good when the McClellan oscillator is below zero. It's no guarantee of a pullback because we've had plenty of times where the market's going up on weaker breadth. But if you look back over multiple years, multiple cycles, the McClellan oscillator below zero means in the short term, you're seeing weaker breadth conditions. That tells me to just be a little more ready and wary for potential pullbacks. You know, we talked about the new 52-week highs, and as I've mentioned many times, a sign of a healthy bull market is an expansion in new 52-week highs, right? If the market is in a bullish trend and that trend is continuing, you have more and more stocks making new 52-week highs. You have those initial names kind of leading the way higher, but as a bull market continues, you should see more and more stocks sort of breaking out of their own congestion areas and continuing to participate. And a bullish market sort of brings everything else, as has been said, a rising tides lift all boats. And so more and more stocks kind of participate, and you have more and more new 52-week highs. Toward the end of the move, toward the end of a bull market rally, you often have the market going higher or at least holding steady, but all of a sudden you see less and less new 52-week highs. And what that implies is that even though the benchmarks are remaining elevated, there are a lot of stocks actually starting to pull back off of their all-time highs. We might be seeing that here. We had a big influx going into the mid-October. This is right around October 15th, where we saw a huge reading. This is the largest, one of the largest readings, if not the largest reading in 2024. I can't tell which one of these is higher, but it's right around the same level, right around, we'll call it 115, 120 stocks. That's about 24% of the S&P 500 made a new 52-week high about a week ago. Today it's down, and actually we don't have today's reading. That'll be updated here in a little bit. But as of yesterday, it was 43, so around 8.5% of the S&P making new 52-week highs. But look at what's happened here in the last week as the S&P has sort of stalled out, and all of a sudden you're seeing less and less stocks on the New York Stock Exchange, less and less stocks on the S&P making new 52-week highs. So that is certainly something to watch as we have a bunch of companies reporting earnings. Especially today, I'm seeing a lot of stocks gapping lower or breaking down after their earnings release, and that is what often would cause a change in the breadth conditions as we're observing here right about now. That could be a bit of a warning sign. All right, a couple ratio charts to share with you. And as a reminder, I do see some great questions coming in on all the platforms we're streaming on. Please make a point of popping a question in there. As it comes up during the show at the end, I'll take a couple questions, and then the rest will go in the mailbag, and maybe we'll be able to answer it on Friday's episode. This is the relative performance of the S&P versus ACWI. And if you're not familiar with that ETF, that comes from a MSCI index. MSCI is Morgan Stanley Capital International. It's sort of the go-to set of international indexes that most institutions would use. I use them in a number of roles at Fidelity and at Bloomberg. We would always look at the MSCI indexes. Those are sort of the go-to levels to watch. iShares has a series of ETFs based on some of those indexes. And I'm looking at the S&P 500 versus ACWI, which is All Country World Index. So basically all global stocks. So this is looking at the U.S. versus the entirety of the global equity market. This ratio has made a new all-time high in the month of October. Now, why are U.S. stocks continuing to go higher? I would say two things. Number one, the strength in the dollar is certainly helping. That's what I'm showing on the bottom panel. So the dollar, sort of hit 100, sort of that parity level, and then sort of popping in the month of October. I've seen a much stronger dollar relative to other currencies. As a result, you can see the U.S. is outperforming non-U.S. markets. So I would say that's part of it. The second thing, and I think really more the story of the broader outperformance of US versus non-US, is just because of the types of stocks that are featured in the US market. If the global equity markets, if the increase in the value of equity markets that we've been observing is about AI and growth and those types of companies, the US benchmarks are way more heavily weighted to those sectors than like Canada, right, which is more basic materials and energy and financials, or Europe, where you have a lot more like consumer staples and things that have a different weight, right? The weightings of the index is very different. So if it's an AI trade and a growth-driven bull market, the U.S. is most likely going to outperform just because of the types of companies that are more prevalent in the U.S. and they're much bigger weights. So I think those two things combining here in October are really causing U.S. outperformance. And all that means is, I don't want to say that you shouldn't be looking outside the U.S. I would never say having absolutely no exposure is probably a good idea. But certainly the incentives of going outside the U.S. are not particularly prevalent at the moment compared to other parts in the cycle, right? When you see a weaker dollar, when you see this ratio going down, that's when you want to start to look outside the U.S. because that means even if the U.S. is doing okay, other markets are doing much better. Keep an eye on this chart. If you do see sort of a major correction or a major pullback happen in Q4 in the US, this sort of ratio can tell you, are there places outside the US that I'm just getting a better opportunity? And maybe that would be the reason to start to go outside the US a little bit. Stocks versus bonds still very much favoring equities over bonds. And that's what this ratio is showing. Is it better to own stocks over bonds? And you can tell for years now it's been stocks. That was not sort of the case in Q3, where all of a sudden bonds outperformed stocks for a period of time here. But that ratio has once again gone to the upside. And that gets me to yesterday. We showed the chart of the 10-year yield. I don't need to revisit that again. But one thing I did want to show you, I was looking at this index earlier. This is the Citi Economic Surprise Index, which is in blue, which essentially looks at a bunch of economic data. This in the U.S., they run global versions that look at global economic indicators and just where did the numbers come out versus expectations. And the fact that this surprise index has been trending higher over the last couple months tells you that basically in the U.S., generally speaking, the economic data has been stronger than normal, which implies, or stronger than expected, which implies that the economy is growing more than economists have expected. And as a result, rates kind of going higher are sort of the bond market's pricing in future economic growth. So the economy is showing signs of strength that were not that are stronger than they were expected. As a result, interest rates tend to go up because further out in the yield curve, that's more of a play on or expectations about future economic growth. And so the market's pricing in that the economy is doing better. And I think that does a couple things. Number one, it tells you rates are probably going to continue to trend higher. The other thing it tells you is that what else was I going to say? Oh, the fact that the pace of rate cuts probably a lot slower than we expected, right? And I would say through the course of this week, we'll maybe take a look over at the futures market and what sort of rate cuts are being priced in through the remainder of this year and into next year. I wouldn't be surprised if it's a lot lesser than not too long ago. These histogram in the background, by the way, is an earnings revision index, and you can see how much earnings have been revised lower. So a lot of these companies that are beating earnings, remember, they're beating the bar for earnings success has been lowered quite a bit here recently as earnings expectations have been revised downward. So did want to share you that one. Again, there's a chart of the 10-year just showing the rates kind of going high. Hopefully that helps you understand a little bit about why rates would be going up and how that might relate to earnings expectations as well. All right, let's look at a couple stocks here to finish off the show, and then I'll take a question or two. We'll be done for the afternoon. NVIDIA making a new all-time high here, intraday basis. Did close slightly lower, but it did trade higher. NVIDIA is very close to being overbought here yet again. So, the NVIDIA trade seems to be strong. I get questions about, is NVIDIA overvalued? I mean, if you're looking at valuations, I don't know how you wouldn't describe NVIDIA as aggressively overvalued, right? I mean, it's trading very high relative to forward expectations, but that's what valuations do in a protracted bull market, right? As prices go higher and higher, unless the company is earning an aggressive amount of money consistently to match the price gains, usually the valuations get higher and higher because the earnings are relatively stable and the prices are going up. And so that means we're more and more valuing higher future expectations. So that's certainly what you're seeing here. Despite the fact that stock like Nvidia is overvalued. Overvalued to me does not tell you to not own it. Overvalued means it's going up a lot and expectations are increasing. That's kind of when I'd probably want to own a stock like Nvidia. Overbought doesn't bother me either. And you can see like January of 2024, we popped into the overbought range. Talk about a horrible time to sell Nvidia, right? That's selling Nvidia at 50 before it goes up to 140, which was the peak in June. So stocks becoming overvalued or overbought are not necessarily a bad thing. As a matter of fact, in the beginning of a protracted rally, that's often what the evidence will tell you. That's why, as a trend follower, I don't sell when things are overextended. I sell when they're no longer overextended. Sell when Nvidia tells you it's no longer a good time to own Nvidia. That's how I would tend to think of a chart like that. Microsoft did bounce out of the Magnificent Seven, your best performer, up just over 2%. I would say still a lot to prove. I like the higher lows in August into September and now into October around 410. I would say getting above 440, which would clear the September high, would make me feel a little better about potential for Microsoft to go further. So clearing 440, RSI pushing above 60. That's what did not happen in September. That's what I would need to see to feel a little more optimistic about a name like Microsoft. We talked earlier, I think this was yesterday, about PACCAR. This is a company reported earnings today in the industrial sector, and industrials have done quite well in certainly some parts of the sector. PACCAR has been rallying over the last 6 weeks, and that's why I thought it was an interesting one to watch here. Last time they reported earnings was back here in July. We had that gap lower. Today, another gap lower, so not a great look. The question was, do we get enough of an upside catalyst from earnings to clear 110? Because that would get us above the July, June, and May highs. Didn't happen. To the contrary, we actually gapped down. It did trade well below the 200-day moving average, right around to $100 a share. It did close right back at the 200-day. So let's see if that's able to hold. But I would say the fact that we gapped lower on earnings and failed to clear that resistance, not a great sign looking forward. Moody's, another one gapping lower about 4% today. Still okay, right? So we're below the 50-day moving average, but still above the early October low. For a lot of these stocks that have been trending higher and now sort of stable, not going up is not necessarily a bad thing. It just means it's not super bullish anymore. But are we breaking down? So a stock like this, gapping lower but remaining above support is kind of okay. That's neutral. Breaking below support is a concern. So we're testing support around 455, the RSI approaching that 50 level. The 40 level, if those levels would fail to hold, I would be concerned as well. Some weird kind of candle bar things happening in the industrial sector. Here's 3M in the top panel. The bottom panel is Raytheon, ticker RTX. Both of these stocks opened higher but closed lower. Now, that is about of a negative sign as I think you could expect around an earnings release or a gap higher, right? When a stock like 3M gaps higher, gaps to a new high, trades to a new 52-week high earlier in the day, but by the close, it's undercut the price action of the last 3 weeks. Think about what that means, right? The stock was bid way up overnight. So we come in the morning, it's opened above 140. Instead of a bunch of buyers going, awesome, 3M's a great buy, I'm going to continue to push it higher, I'm thrilled to get in here. That's not what happened. You had a bunch of selling, and by the end of the day, we've gone down, 9 points, 8 or 9 points going into the close. So that created what's called a bearish engulfing pattern for 3M. It was not as bad for Raytheon. It wasn't really a classic bearish engulfing pattern, but both of these a bearish outside day, meaning we opened higher and closed lower. The range was bigger, and that really represents negative sentiment through the course of the day. So both of those, I would say, not a great look on earnings. Lockheed Martin, obviously in the same kind of category as Raytheon on the previous chart. LMT was down over 6% today. What's interesting about LMT going into today's report is that we were trending higher, but on weaker momentum. So going into today, we had that bearish momentum divergence. And when you have that going into earnings, that's always something I'm a little concerned about, because that means the price is going higher, but on weaker momentum, which implies it's less bullish than what the price action is suggesting. Sure enough, we gapped lower today and traded all the way down just slightly below the 50-day moving average. On any of these names that have had big moves lower today, the question for me is follow through. So I think going into tomorrow's session, the question is, are people thrilled to buy Lockheed Martin at a steep discount from where it was about a week ago? or do you see additional selling? And I think the way you answer that question will tell you a lot about the direction of momentum going forward. And I don't like to tend to fight that sort of move. Final chart, then I'll bring a question or two from the crowd here. GE Aerospace, right? So GE spun off into a couple different businesses earlier. I forget. I think it was last year, earlier this year. I've lost track. But GE, ticker GE, is now GE Aerospace, gapped lower. And again, the fact that a stock gapped lower is not the end of the world. That happens. I would say similar to what we saw with LMT. We had a bearish momentum divergence going into today's report, which is kind of a black eye of sorts as the GE was making a new high. But what concerns me is the fact that this is a stock that gapped lower by almost 10% on pretty decent earnings. If you look at the data, there were some subtleties, right? So the top line and the bottom line numbers, they kind of beat. But if you look at some of the specific thematic moves, so some of the segments within GE Aerospace, some of them not as good as expected, right? In areas like defense, if I remember right. I looked very quickly before we kicked off the show. So maybe that's part of it. But I'm seeing a company that reported well, that actually had pretty good guidance going forward, and the stock's down a lot. So that really speaks to investors unwinding positions because of the overextended nature of the chart, not because they're worried about what the company is going to do. And that often is more aligned with a market top. When you see stocks selling off on good news, that means people are just trying to get out of the way of and avoid being that last sucker that's buying these stocks that are going to go higher, and it's causing the stock to get dinged pretty good. So overall, to summarize today's trading, not horrible in terms of the top line indexes, but if you look at a lot of the individual stocks, I would say some very concerning breakdowns, really speaking to the weaker breadth and volume conditions we've been talking about recently. I think sort of really playing out through the course of the day today. All right, let's take a question or two. Oh yeah, Alu, thank you so much on YouTube. You mentioned, and Goldman issued a report stating the next 10 years will only deliver around 3% per annum, right? And you're absolutely right. I actually didn't mention that. My cup runneth over of things to talk about on a 30-minute show today, so I didn't get to that. You're absolutely right. There are a couple reports that have come out here about long-term outlooks and lowering expectations. And I got to tell you, if you think it's tough to predict them, it's hard enough trying to predict a market, just in the next 24 hours, or in the next month. Forget about the next decade, right? What the world will look like 10 years from now, no one knows. These are, very major league guesswork trying to predict what a market is going to do over the next 10 years and how correct that's going to be. I would say highly unlikely it's going to be super accurate, but it does tell you, I think, where there is value is what it tells you about expectations. And again, I didn't read the full report. I'll hope to, but I'm guessing what they're talking about is we've had a period of aggressive bullish activity, right? For years now, we've seen a nice rally off of the COVID low. Sort of the post-COVID era has been remarkably strong for risk assets. And if you're tempering your expectations, maybe this is no longer the wild west of AI stocks being bid up to aggressive upside. It's more of a tempered expectations, and certainly maybe that could be playing into this as well. A great point. Let's see, eccentric CCCC. That's 4 C's in one name. Congrats for that one. You mentioned look at the MOVE index. Not a question, but I'll take it. Let's see. Let me take a look, because I actually have that, I think, in a sentiment chart list. I've got the VIX and the MOVE index together. I've not looked at the MOVE index. I don't have that on my more normal charts. Yeah, really interesting point, right? So the VIX is on the bottom panel in purple. The MOVE index is in black in the top panel. The VIX is essentially implying volatility for the equity markets using S&P index options. The MOVE index is kind of doing the same thing, but for the bond markets, kind of like a volatility expectation for bonds. Look at what's happened here. And particularly in the last couple of weeks, the VIX has been coming off a bit, which feels like a bit of a head scratcher because the market feels more volatile than that, while the MOVE index is actually breaking out to a new 6-month high this week. Great call. Thanks for bringing that up. I had not looked at the MOVE index, and I would 100% agree. I think this is one of those times when, when the bond markets and the equity markets are disagreeing. I would argue 9 times out of 10, the bond market, it pays to make sense to pay attention. I mean, traditionally speaking, bonds tend to lead stocks in terms of changes. And I think it's all about, for me, my experience is it's about the expectations of bond investors. They tend to be really good at assessing potential risks. And bond markets, at least as measured by the move, are pricing in a little more volatile expectations here going forward. Thanks for that question and pointing me to the MOVE index. Folks, that is a wrap for the show. I want to thank you so much for joining me every weekday after the close for Chart This. Appreciate you suggesting the show to others. Tell your friends, tell other investors that you know, chat rooms that you're in outside of what I do. Appreciate you sharing the good word about Chart This. Really hoping to grow a community of investors and traders trying to make sense of the markets using charts, technical analysis, and behavioral techniques, some of the things that I share on the show. And appreciate your help getting the word out. Look for those podcast episodes on my YouTube channel here over the next couple of days. And in the meantime, I'm Dave Keller with Market Misbehavior. Remember, it's always a good time to own good charts. Have a great night.